It is the fourth year in a row that Kenya Airways is hitting the headlines for all the wrong reasons. The airline has yet again broken records in loss-making after announcing a full-year loss of 26.2 billion shillings from the 25.7 billion shillings made in a similar period last year. This means Kenya Airways made 49,895 shillings per minute in losses, which Chief Executive Mbuvi Nguze attributes to volatility in exchange rate and fuel prices, as well as changing price commodity environment.
Improvement in operating loss of 12 billion, but that has been negated by two or three big things. Number one, exchange rate movement. If I look at just differences, exchange rate movement of 9 billion, and increase in borrowing costs of another 3 billion. So you have a benefit, and then you have a cost. You have costs which are below the line that have actually pulled us down, and that's why we end up at the same level of loss. And that is partly the reason why, as I said, that we are looking at our capital optimization structure, because how do we reduce our interest costs? And then we will have to mitigate the exchange rate issues based on the evolution of the market. That one is totally out of control.
This is despite the sales of property, aircrafts, a landing spot at Heathrow that earned Kenya Airways 7.2 billion shillings, as well as subleasing of aircrafts and lower fuel prices experienced over the last 2 years.
These are part of the initiatives that we have taken in order to reduce our structural capacity. I think one of the big asks that the board had of us was, how do you reduce the capacity today in order to reduce the cash flow out that is not generating value for us? So we've taken out 5 aircraft, subleased, we've sold 2 aircraft. We've said that we have a target of generating value over $200 million of value over the next 18 to 24 months. And that's really our target in terms of coming back to profitability.
The sale and subleasing of aircraft saw passenger numbers rise 5% to 4.23 million shillings, with the cabin factor increasing to 68.3%.
That the capacity we deployed, and as Moses has said, we reduced the capacity was less, but the uptake of that capacity or the utilization of that capacity went up. And that's why our cabin factor stood at 68.3%.
The airline's financials shows that Kenya Airways booked a gain of 1.7 billion shillings on hedged fuel, but lost 4.15 billion shillings to forex hedging, narrowing than the 7.45 billion shillings loss it recorded the previous year. The financial status of Kenya Airways has seen other airlines express interest in buying stakes in KQ, but the board is keen on flying the airline back to profit territory.
As at now, if we were to take on an investor, we would probably have a problem setting a valuation for the airline. As Dick has pointed out, we're into negative equity. So it is a process, it's a journey. We turn the corner, we make the airline more attractive, then we know we will be able to attract new investors at that time, if that is the route that we eventually settle on.
The financials indicate that this year's KQ shareholders made a loss of 17 shillings and 53 cents per share. Although KQ reaffirms its progress towards recovery, the figures tend to show a different picture. The loss they made was largely unchanged from the loss they made last year. This is attributed to external factors such as the shilling strengthening against the dollar and also the cost of borrowing, which went up, incurring a 2.3 billion shillings in interest expense. Caroline Jega for NewsHour Business.